So the other day, on Monday, we were discussing about candlestick patterns and their meaning, right? What they mean in the market, how we want to do analysis. So today we are continuing to stuff. And last week we talked about the bullish and blocking candle. Right? Talked about the bullish and blocking candle. And we have to talk about the second one before I ended the class. So, and in the course of this few time that we did go class, somebody actually did the analysis and went to me. I was quite impressed by what she did because it showed that she was actually paying attention to the class. So maybe I'm doing it. So that made me very good. I'm trying to pull out that moment and I'll share it with you and see what she did. In the course of the week, let me do this analysis. So this is on soul wealth. This is what she did in 15 minutes time. She spent 2 community at it. And for me to be honest, this is good analysis and see what she did. So let's pull up that particular chart. Pull up that particular chart. That should be so good. The analysis for them. Now, the analysis we make
I barely hear you. I don't know if it's my network.
okay, I guess this is the analysis we did. Right? This was the point she marked. You can still from here. This is the point that she marked for our entry. And she took the entry around there and was targeting to get to this point. Stop loss should be around somewhere. Okay, so this is the good analysis, right? Getting. Because when I check the chart, I said that I'm going to just explain some things to you from the analysis tool. Now, this analysis is a very good analysis. Because if you take this line backward, you see that it was a resistance line, a support line. You can see it supported the market for a period of time before breaking through. So now that it has broken through, it has come to its support. So we saw it here and we also expecting to also come down here. Now, but that is not what the market did here. You can see that the market entered, look above the support and entered, look above the resistance level and entered a form of a range. And you may be wondering why this kind of stuff, right? So we learn that in the course of the class. When you see entries like this, most of the time, this point of entry will not move, not always, but most times. The reason why this one will not move is because there is a higher one. So the one that is moved is usually stronger. And if you check this particular trend from the higher time, you discover that this point we are taking the entry is just a retracement point, like see it move here, trade and come down. So if the market should break above this point, then we are looking at coming upward towards this direction. So this is how we expect the market to move at this point. Because it has actually broken this structure. Remember, this is a low and this is a low. And a lower, this is a high. And this is a lower high. And the lower high was now this thing is coming up. We want it breaks through this particular lower high, then the market is changing direction to the upside. But overall, you check the overall trends, this market has not changed the trends. If you guys understand what I'm get just trying to take a view of what happens in the right. Now, if you check the overall trend of this trend, you discover that it's a downward trend from this point. So we have this first point, we have another point, and the market kept coming down, then it came to this point. Now, this is still a downtrend. The market is still a downtrend if you check the overall trend. But if you are looking at this brief trend here, then the market is still a bearish trend, right? This is the previous low, right? This is the most valid previous low that the market formed. So this low gave birth to this high. So for this market to change trend, and we know that it's selling, you have to break through this low first. So if you break through this low, then we expect a retracement level to drop from the downside. This is why this market did not go, because this low was not broken, rather just stepped on it and started climbing gradually. So that's by the way, you did a good job with any knowledge you don't put to practice will not be true. So I encourage you guys, practice, send me your analysis. That's why you get the money you pay for this class. 120K to learn, not a days. So do your due diligence, everything we have learned. Make sure you put it to practice. Look at the chart, do your analysis, send it. I will look at it, I'll tell you if you are right, or you need to adjust one or two places like this, and this is where you are making mistakes. Now, by then, you'll be going faster than just waiting for the class. Remember, I said, put what we have learned to practice. Don't go to YouTube and be looking at videos so that you don't get confused. When it's time for you to be looking for resources online, or this, if you want to look for resources online, look for the resources that are in line with what we have learned. If we are in candlestick pattern, look for resources that are in candlestick pattern and broaden your knowledge. But don't go and be looking for resources that tell you about price action, tell you about all those more advanced things that we have not discussed here. So that you don't cloud your mind with too much information at the end. Decision making will be a problem. So that is by the way. All right, so let's go. So last week we discussed bullish engulfing, right? And we said the bullish engulfing usually takes place at the bottom of the trend, at the bottom of the trend, and it signifies a possible reversal of the trend from a bearish to a bullish trend. That is what the bullish engulfing entails. Every time you see a bullish engulfing, we are hoping that that in particular market is about to change trend from sell to buy. Today we are discussing the bullish here. Can you guys hear me, please?
Yes, sir.
Yes.
So today we are discussing the bullish around the United States. So we have the bullish around. So the other time it was bullish engulfing. Today we are going to talk about the bullish harami, right? Now, bullish harami also happens at the bottom of the chart. When the trend is going downward, the bullish harami usually happens at the extreme end of the chart, and it represents a possible reversal to the upside, right? Just like the bullish engulfing represents a possible reversal to the upside. Same thing applies to the bullish harami. It symbolizing that this market, okay, sellers are no longer interested in selling in the market, buyers are now in charge of the market. That is what the bullish harami actually represents. Now, how is the bullish harami formed? The bullish harami is formed when a candle, right? The bullish harami is usually, in the case of the engulfing, it was one candle engulfing over the other candle. But in the case of the bullish harami, it is a two-candle pattern, right? A two-candle pattern. And the bullish harami is usually characterized by the formation of a small body, which is the green, which is the bullish small body, right? Candle before a larger body of the bearish candle. So let me explain what that is. If you look at this, this place here, you see that okay, I said the bullish harami. Maybe I'll write it somewhere. The bullish harami is usually this is what I was trying to explain. So the bullish harami candlestick pattern is a two-candle pattern. It's usually characterized by the formation of a small body candle, right? Because it takes two candle formation to give you a bullish harami. So one is a small body, which is usually a bullish candle, right? Which is why it is green here, and then a large red body candle, which is the bullish one. Now, the occurrence of this pattern typically occurs at the bottom of the chart and indicates a possible reversal, a bearish trend towards bullish side. So this is what we are talking about. The market is trending downward, as you can see here, and we have this bearish candle. You see this fat candle here, very big. Then the next candle that was formed was a small candle. Now this small candle opened above the closing. This is the closing, right? Remember, I told you that when the candle wants to close, we have the open. Let's use the candle here. We have the open price, we have the low, we have the high, and the close. For every candlestick, right? For every candle that you see, we have the open. Let me bring it up again. I spoke about it last week on Monday. So we have the open, right? For every single candle, we have open, as you can see it here. We have the open, the high, the close, and the low. The same with the bearish. So if we bring these two together, look at these two charts very well, you discover that this red candle, this bearish candle here, this one before this green, at the bottom, the two last candle at the bottom, you discover that this is red, so the open is at the top, right? The candle opened at the top, rose to this point. So this is the high, and then rose down, came down. This is the low, and then it closed here. So this is the closing. You can see the illustration from here. So this is the closing point of this particular candle. Now, this red candle that is being formed, what happened? It opened above the closing of this candle. Now, if in case of a bullish candle, remember this is the close. So the up here is the close, the open is this place. So this is the open price, and this is the low, and this is the high. So imagine, look at the point it is opening. This candle closes here, closed at this point, the red one. But this, when the candle closes, the next one is supposed to open from the point that that particular candle closed. But this one opened here, like you can see, and when it was closed, it did not even close maybe above this high or above this close. It also closed below it. So that's why I'm using this. You can see open price, open above the prior closing. So this is open above this closing, and also close it below the high, the prior open. So the price opened here, this one closed here, this one opened here. So this one closing is lower than the opening price of this one, and the opening price of this one is lower than the closing price of this. The moment this formation is gotten at the bottom of any chart, provided the chart has been in a bearish move, and you see this Harami pattern, then you know that the market is about to change trend. That is all I'm trying to explain here. So let's go to the chart and look for this pattern, a bullish Harami pattern, right? Let's look for it. The reason why I'm teaching you all these things is so that you can know them, right? Many of the time you may not really use them to do entry because you will not often see them that easily. But knowing them will give you an edge so that when you are doing your analysis and you spot anything of such, you immediately know what to do. So let's look at another chart. Look at it in this point. Let's check. So if you see this point that I have just marked, this red and this green, you will see that here, let me paste this so that you can be seeing the illustration. So firstly, we have this red candle. And remember that for the red candle, which is the bearish candle, we have the low. The low is the last point of the week. Then we have the open price at the top. Open price at the top here, the high, which is this point. Then this is the point of closing, right? So the market closed here, as you can see. Then for the red, this is the open price. So this is not even it because it did not open above the closing. So this is not a valid RMO. It did not open above this price. So we cannot take this. If we take this, it's a 50-50 chance. And if you are taking this entry, put your stop loss down here, just super. So let's fetch the chart. We see something that we are following.
Yes, sir.
I can explain. If you have any question, just be noting them down, right? So that you don't forget it. Note them down. When it's time for question, you can ask your questions. Thanks. See that being the pattern is not that new. So you will not depend on all these statistical patterns to take your approach. But they will give you insight to what the market is doing when you know the value. So knowing the values dynamically, when you are doing your analysis and you see parametric patterns something, you immediately know that there is potential for that certain district. Let's watch and see what will happen. But if you combine it with your other analysis and your push, you can take them a good profitable entry. Right? This pattern happens for trading market. If the market is not trading, we cannot use this around. The market has to be in a particular position. Again, I'm seeing some words. They are not, we can't take them to be valid because for an anomaly to be valid, the market has to be in a trend. The market has to be in a downward trend. To be valid. The market has to be in a downward trend. So that pattern will indicate a reversal. You can see some inside, that's not let's discuss the others. and then we'll take session with you. Let's see which are running to mark it down and use it. Yes, so we have the English and then we also have other areas not understood which is choose that button, right? Choose that button. It's called choose that button. Choose that button, right? Let me build up the chat and show you what choose that button looks like. This is what choose that button looks like. And the trigger button is the data pattern as well, right? It represents the market is a back of the graph, which market has been very yes. Now it wants to reverse. So the market is going to come. So that is for the bullish reverse. Is that button, right? So the pattern consists of two or more candles with equal or an identical moves forming a horizontal support level. This candle pattern is typically formed at the bottom of the price chart and signals potential shifts of momentum from bearish to bullish. Maybe let me put the right up here. This is what I'm trying to explain. Is that working well? This is what I'm saying. Then the trigger bottom candlestick pattern is the bullish reversal, right? So it's also the reversing market to the bullish side. Now the pattern consists of two or more candles with equal or identical moves forming a horizontal support. So this is what I'm trying to explain. So the candle is moving like this, right? And another one, this is a bullish candle now, a bearish candle coming to the downside. So let's mark it with red color, right? Then we now have another candle like this, which is bearish, bullish, right? So we have this, and both of them are of identical size. So let's change this one to. So they are almost the same in size, such that you can literally draw in base, single base for them. Like if you put your line, it's going to be a single base for the two. Both of them are almost identical or identical size. That is what the twister button looks like. So this type of candlestick is typically formed at the bottom of the price chart and signals a potential shift in momentum bearish to bullish. So look at this picture here. You see this line drawn here. You see that both of them have the same base. You see. So the lowest point of these two candles is the same or almost the same. Then you see the body here. The candle moved, and this one, you see the closing, the open and close of this particular candle. Both of them are almost the same. For the this top and at the bottom they are the same. So you can see that when you see something like this, it signifies the potential shift And these patterns are very common in the market, right? Very common in the market. If we look for patterns like that, you are going to see a lot of them in the market. You see first a bearish candle, then another bullish candle of equal size. That particular one, when the market is forming a particular downtrend. This is an example of one. You can see this bearish candle and this bullish, almost the same size. You can see what happened to the market. That's example number one. And let's give elegance first.
Sir, are you there?
All right. Can you hear me?
I can hear.
All right. So, as I was explaining, I was trying to show you choose that button examples, right? So, let's look for some other examples of choose that button. We look at the choose that button, the kind of candlestick that after the bearish is formed, the bullish and the bearish have identical or equal lows and almost same size. The most important thing is we are looking at the low. If they have identical or equal low in a trending market, take note, the market must be trending. If the market is not trending, maybe it's in a range and you see twister bottom, it's not going to be that strong compared to when the market is trending. Because when the market is trending and you see that twister bottom, it's a signal that the market is about to shift momentum from sell to buy. So let's see some examples of twister bottom. The documentation that if you look at the chart, the same things we have discussed, seen them on the chart and you try to do your next. Use the relevant plan and test that as we look at Twitter, the market is trending down and then you have this range. This is like the ranging market. Right? And this one is not valid because the low is lower than this one's low. Right? And these two, they are not also valid because see that this one, the low, is a bit farther than this one, even though they are close, but it's not the same. But if you bring it here, see that they have equal lows. See that the low is equal. So this is the trigger button. This one will signifies and it change from this bearish to bullish. So this is the trigger button. You can see that here, and then you see what happens in the market gets going up and going up and going up. Right? So this is a good example of the trigger button. You see it here. Trigger button, these two candles. So that's what I wanted to do for trading. Every time trigger button, though it will not work 100% of the time, but 90% of the time, when you see a trigger button, the market is likely to change direction. You can see that the line is true. The market came back to it. So if maybe when you saw this, there was already this huge move. Maybe you saw the market around here, just around here. Now it will not be wise for you to be taking action here, targeting like this, because your stop loss must be below this entire load that comes to that bottom. This entire. So imagine taking this kind of trade. This is a loss because you are risking so much to gain very little. So this is a bad trade, right? But since you have already missed the entry, what you can do is to come back and wait for it at this point. Remember the rule: mark the candle, then wait for the trade. Right? If you do that, let's drag it to the right side and see if the market actually returns that point. So if it does not return, look for another entry. It does, then it's a win for you. And you can see what happens. Market actually returns to that bottom zone. But that bottom became a demand zone that pushes the market, the price upward. So now that the price has been pushed up, then this zone, which is that trigger zone, is now our point of interest. And you can see what happened when the market came, there was a push. So if we take our entry side here now, you can imagine the profit we made. Stop loss will be just around here, and our take profit will be the high of that particular the high. Remember the rule, this point. Let me know. Okay, so this is the highest point between the bottom. Remove it all. You don't want to be you want to always play that high. So they also have other highs. All these highs, the market is coming back. Market. When you are placing your entry, you can now know which one you take as a take profit, which one you take as a point of entry. Anyway, I believe you saw what right. So this is the point. So this is the point. Imagine if you are taking this entry, you are plotting this right. So just like waiting for it to come to that point, see that you target this high, that will be 1 to 5. So this $5 will give you $25. This is 1 to 5. And if you want to get the market to take the highest point, which is this high, you can take it as high as this, and you see 1 to 12. So you are risking $5 to get 60. That's what it means. Then what I will always recommend is to take two entries and reduce your risk and take two entries. So first one should stop you. So the first one should stop there, which is 1 to 5, and the second one you are alive to come. So while it's going up, you will be shifting your stop loss, shifting your stop loss, shifting your stop loss. The better it becomes, mean that you can see that we have actually got even exceeded that point far ahead. So that is what happens when you see that. If we from that point that trigger was, you see that the market has been trending downward. You see that it has been this is downward. You see the trend here. You see the move that is coming down, a downward trend. All this while. So the moment the trigger was formed here, see that the market changed direction. Here, the market changed direction and it became a bullish market. Right? And this market is still bullish. So we expect this market to still go. So what we expect this market to do now, come down a bit like this, and after taking out the stop loss and start going, or the market can also decide to come up to take stop losses and then come down. If this happens, based on the pattern that is formed for us, we know if the market is actually passing downward or going upward. Then we can make our decision that yes, it's just like we made a decision by seeing that Tuesday, we can make our decision to see as the pattern is up, right? So that is, we have discussed three major trend candlestick patterns today. We discussed the bullish Arami, and we discussed this one, which is the trigger bottom, and we also discussed the two. We have discussed two now: trigger bottom and bullish Arami, right? So these are the ones I want us to take for now, so that we can send questions so we can continue. But it is worthy of note that the trigger of the bullish Arami had a success rate of 54% plus, right? Meaning that for every 100% trade, every 100 trades you take using just the bullish Arami pattern, you did not do any analysis, just saw the bullish Arami and took the trade. You are out of 100, you are likely to win 54 out of that 100. So you have a success rate of 54%. That's what I'm trying to say. From back testing that have been done over a couple of times in different market environments and different simulations, it has been deduced that 54% is the success rate of the bullish Arami. So you can do your calculation of that. If you are using a risk reward, 54% that's what it is. I also want to fine tune things to be maybe 60 to 70% in the market, right? Then if you are talking about the bullish, we talked about that on Monday, which is the Gulfing candle. The Gulfing candle has a success rate of 55%. All these are based on analysis and backtesting, using it for a period of time, exposing it to different market conditions. So the bullish Gulfing have a success rate of 55%. Bullish Arami have a success rate of 54%. Why this one I just put it as a trigger bottom have a success rate of 61%. So you can see the percent, and you see that if you see trigger bottom and Gulfing, or you see the other movie, by using only those patterns to take your trade, you should know what to explain. You know that out of 100 trade you take, this is the percentage that is likely. All right, let's get the question to discuss dynamics. So, any question?
Okay. Yeah, I have a question. First of all, I think the network is kind of bad. Your voice has been breaking. But this example gave us last now. How my question is, I saw when you took if you said if you want to take an entry from that tweezer bottom, that's my question is basically how do you know, because now the market just if you are taking it from that bottom, the market is beginning to turn to take a reversal to be bullish. How do you now know the heights where to stop your take profits? Because I did not see any other say any other thing you are using to measure that height really. So that's one of my questions. And the second one would be the analysis you did at the before for the trade the analysis I sent you. I didn't really get the explanation because the network was bad. So I don't know why the market did not go the way it was and I analyzed it. I didn't hear what you explained, please. So these are my two questions. So did you hear me?
Yes, I'm looking for that to get what I'm doing. It's game to you, God guaranteed. In your thinking, so that I'm looking for the one that the two part of the two points. So you are saying that how do we calculate the stop loss and the trade profit, right?
Yes, sir.
Having identified your trigger button, the first thing you want to get is your stop loss. So where should be our stop loss? Obviously at the low, right? So you give it a little space because of stop loss at the moment. So this will be our stop loss. So let's be very interested. So this is our stop loss. And here we want to take entry. So let's be very entry. So now we want to take our entry from this point because this is the tracer bottom, right? Let's change the label. This one is down. So this is our trigger bottom. Now we want to take an entry because the candle have to close before you know that yes, this connection is okay. So this is the point the candle closed. So we want to take an entry here. So put our stop loss. We will call this entry, right? Call this entry. Okay. Now we have our stop loss and this is the reason why we're taking the entry because is that button was formed here. If you want to take profit, like your here to stop, it should be the previous high, which is here, right? The previous high is this point. So here can be your CP. So this will be your CP. This high here. Do you understand how I think it now?
Yes, I'm getting you.
So this point will be your CP. So this point is going to be your tipping point, right? This is going to be a tipping point. The previous high before the actually formed that trigger button is going to be your entry, your take profit, which is this point. This point, right? So this is the previous high before this move. So you want to take your profit around here so that should in case the market decide to turn from here, you'll be safe. You are taking what you want to take. And if you take this entry from this our entry point that we labeled and put it here, should be having some decent profit, right? And this is our stop loss. So you can see that by doing this, we have okay 1 to 1, not really that much, but of course, you can still take it a sharp entry and get the market, right? So you see that the market don't move quickly and take your take profit. So you are taking your profit and you can now leave the market to do its thing until you see another signal. Now, in a situation where you miss this move, you have identified your trigger bottom. Now your entry is supposed to be here. You have missed this move. The market have moved to probably around this place. Now you know that it is not safe for you to be taking entry here without any further confirmation. And instead, what you want to do is you say, okay, since it has been like you want to wait for the market to return to this particular candle that caused that move. So if you are waiting for the candle that caused that move here, which is this candle, it is simple. You just keep waiting, you wait for it, and if it should return. Now, this is the point I believe you got. Remember that this is the previous high that we took, but this trend gave us its own high, and this is the high of this trend. We agree from here to this point is one, right? So this is the high of this move from here. So this, if you are waiting for the market to return to this zone before you take your entry, this will not be your take profit, not this one. The reason why you are targeting this one is because this is the high formed from this move. So it is safe for you to take an entry at this point. Then if maybe you see that the market formed all this and it did not also come to this point, then the market formed another high here at this top. So this new high can also be a target for you. So this is a high, you can target that high, and you can also target this high. The reason why you are targeting that other high is because this whole move gave birth to this one again. So from here down to that point is another move. So what you want to do is you don't want to put all your eggs in one basket. So what you do is when the market returns to this same zone for you, if you move forward, you see that the market actually did return. So now when the market returns to this zone for you, and you have gotten your confirmation to take your buy entry, you take two entries. Take the first one, take the second one. Now the first one, your target should be this place, this TP that I mentioned. This one is twist that button. Which one is this one? Let's look at it. So this is the TP. 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 This is the So now we have this thinking point, which is the previous high. It was the previous high that was formed, which is from this move. But you can see that if you zoom in, you see that this move was really long. So this is another target. So we are targeting this first move before the retracement, and this move before the next retracement. You can also target it. So in order to do not put all your eggs in one basket, you are targeting this first one. The stop loss will be here. This will be your entry and your target, and the next target will not be this move. So what you are doing in this case is, if the market should return to this point for you, after this one, this take profit has been hit, you can see the market moved and straightly hit this take profit without wasting time. Now that you have hit this take profit, the next thing you want to do is to begin to shift your entry. So you took the entry around here, the market did retracement and went up. You now shift your entry, your stop loss to be under here. This is your stop loss. You shift it here. So with this approach that you have done, you are taking this first profit and it's now your own. Then this second one that you are targeting, you are breaking even so that the market should turn against you. It's going to close you from the market with profit without you losing any money. But you can see that the market came, and when this retracement was done, you can now take your stop loss and put it here under this new retracement. So you see that after the retracement it went. So if assuming maybe you were targeting somewhere higher and your take profit is not hit, when this retracement comes, you see that you can hit your stop loss. So you are going to exit the market at this point. So identifying your take profit is just you looking for recent highs or lows to put your target. In this case, if you take the trade immediately after the trigger was formed, you take this previous, the lower high as your target. But if you are taking the entry after all this move, then that return, then you can target the high, the move, the high of that move as target point. I don't know if that answered your question.
Yes, sir.
All right. So any other question? Okay. No other question.
Yes, sir. I have a. Can you hear me? Okay. In the bullish harami, as you said is characterized by formation of a small body. That is the green candle is small body, then the larger body, the red candle. So you said it's only the you had like dealing with just the opening and the closing. Hello, sir. Huh? Okay. Okay, sir. So, and you also said that how about the high and low? That's the line in between the candlestick. What if there is no line at all? Because yesterday when I was going through some charts, I saw that some candlestick doesn't have a line at all, just the full body. Can you still analyze with that without having the high and low?
That question will be answered by this. So let's remember this and show you what I want to show you. So let's please open. something. From here you can see that they have this particular it does not have a big body. Right? There's no
Yes.
big body. All we have is just angle size. Can see it here. So if this is the case, then we can see as long as we know they are identical, right? They are identical like equal loads. That's what we are looking for. If the two candles have equal loads and the heights are almost the same as well, then you can use it for your analysis. It must not have a wick for you use.
Okay.
You understand?
Yes.
So you understand that, right?
Okay. All right, sir.
For the bullish parameter or for the Twitter button, sir.
Yes, Joshua, what are you saying? Which of them?
I said this illustration you gave, is it both for the bullish parameter and also for the tweezer button?
This one is for Twitter button. Twitter button. They have equal or identical names. That's how you identify them. For the bullish parameter you're talking about, they don't usually the opening of the green candle is above the close of the red candle, and the close of the green candle denotes the high or the opening of the other candle. That is for Harami. But this one I just explained is for the Twitter button.
Sir. If there will be, hello sir, if there will be maybe a picture and with brief of this note that will be sent to us in the group so that we can study it, I think it will be better. In addition to what you just illustrate, so that we can see, since you can't give us the direct illustration from the bullish parameter via this chart, I think it will be better that way, sir, to help.
No other question, right?
I have a question, so I just want to be clear concerning the tweezer bottom and the bullish Harami. I want to be sure whether are we not looking at the wick or just the closing and the opening of the body?
On the Twitter button, the wick is included. If the candle has a wick, you can include the wick. But if it does not have a wick, has a body, the two candles that you are looking at have that identical button, like equal loads, even though it's not a wick, but the body is full and it has equal loads, you can use it as well. If the wicks are the one that is having the equal loads, you can also use them as well. Did that answer your question?
Yes, sir.
All right. So any other one? Okay. If there's no other question, I'll end this class here today. Yes, I'll work on that. If there is no other question, this class will end here. I will send you resources that you can also go through. And I'll make the video available this one to this video class and that of one to going to download them and send them to you. Like you have to go through that your company. Then remember Friday, have between Friday classes. So prepare yourself to get that Friday class and to be sharing your screen with us. When you share your screen, and you are also going to be doing some analysis. So in your own time, from now to that Friday, so you have today, you have tomorrow, right? What we do is we can choose any pair of your choice. Pick any pair of your choice, go through the pair, identify some of those rules that we have discussed about, like the Aramini, the Twitter button, the English involving, identify those points or in your own chat, mark it down so that on Friday when you share your screen, you can now tell us that okay, this is what I have found in my own chat, this is my own chat. Maybe I'm going to even send everybody a different pair, like I'll mention your name and add a pair to it. So from that to that, you look into that pair, screw to the other things. You can use your phone, you can use your system. Look at the pair, identify those zones, mark them down. You see a support zone, mark it. You will explain to us why it's a support zone. If you see a supply and demand zone, mark it. You tell us why it is so. If you see a Twitter button, you see a bullish engulfing, you see a Harami, mark all of them. On that day, on Friday, when you share your screen, then you explain to us why you did that is so. Then we can now do our due diligence by either correction or acknowledging you for your perfect work. So that is how we are going to do this Friday school. Okay? So prepare yourself. When you see your pay, as I mentioned that this is very just begin checking the chart to identify some of those things and go to that is where we begin with that. And that's the information that has. We'll see you on Friday. You can continue your in the chat that was in group. And once I stand, we can see the opportunity to